Hey, how you doing? And welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts, brought to you by Livewire Markets. I'm Ali Selby, and in the last episode, my colleague Chris Conway spoke with Darren Brown from Octopus Investments. They discussed the transformative changes in the energy sector, the strategic initiatives underway, and the opportunities for investors in the renewable energy market in Australia. This week, we are talking all about growth investing. It's been a spectacular few years for growth stocks after a truly miserable 2022, with investors looking for growth as inflation started to bite. The AI thematic saw these stocks explode even further, with some market commentators predicting it kickstarted a new earnings growth cycle for mega-cap tech companies. Today, we're sitting down with Josh Cummings, a portfolio manager and research analyst of the Global Research Growth Fund at Janus Henderson. We're going to be learning how Josh and his team identify stocks, a process that has helped them consistently beat the benchmark over the long term, why the good times for growth can continue, as well as some of Josh's best investment ideas today. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber yet? What are you doing? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from leading investment minds in the country. Okay, let's get on with the show now. Thank you so much for joining us today on The Rules of Investing. Josh, it's awesome to have you here in Sydney, all the way from the US. How are you liking it so far?
Well, I love this country. Thank you for having me, Ali. It's a pleasure to be here. You may not know this, but I was a former resident of Sydney. I studied at University of New South Wales for a semester. During my undergraduate studies, I studied monetary economics here. Spent a lot of time on Coogee Beach, but also a lot of time in the classroom. Happy to be back.
That's the nice part of Sydney for sure. I've recently been working on some pieces with Morningstar on batting average, which is a measure used by cricket, softball, and baseball fans to help them track a player's ability to consistently score runs. We've been doing the same thing with funds here at Livewire by tracking their ability to outperform the index over rolling 1 and 3 year periods over 5 and 10 years respectively. Congrats, your fund made the top 5 over both 5 and 10 years in the global growth category. What do you think the secret is to consistent long-term outperformance?
Yeah, excellent question. For us, we think it's deep domain expertise and the fact that Janus Henderson is a place that has always encouraged career analysts. So if you look across our analyst team, there's about 35 analysts that are responsible for our research fund strategies, of which global research growth is one. The average tenure of these analysts is about 17 years.
Wow.
Many of us have been doing it a lot longer than that. I've been in equity research for 28 years. It's all I've ever done professionally. It is my passion. It is my love. And I think that engenders deep domain expertise over time, as well as deep relationships with the important management teams in our various industries.
Let's go a little bit more short term. It's been a truly fantastic year for growth investors, despite that little blip in August.
Yes.
Looking back, what do you feel you got right this year and what did you get wrong?
I think from a stock selection perspective, we've been fundamentally bullish on the mega cap stocks, if you will, the names that a lot of people here and elsewhere certainly have heard of, the Metas, the Googles, the Netflixes of the world. We've liked them not necessarily because they've been momentum stocks. That's not how we invest. We're fundamental investors. We've liked the fundamentals, namely free cash flow generation. These are exceptional business models. I'm unfortunately, I suppose, old enough to remember the tech bubble in 99 and 2000. And if you look at the leading companies of the day then versus the let's call it the Mag 6 or the Mag 7 now, dramatic difference in business models. These are highly profitable, capital light, free cash flow generative businesses, broadly speaking. And we've been fortunate enough to have liked these fundamentally and benefited from it.
In the intro, I talked about some market commentators saying that AI has really kickstarted this new earnings growth cycle for those mega cap tech companies. Do you agree with that?
Yeah. I think one of the things that we feel we're good at Janus Henderson is understanding disruption. and understanding digitization, especially, which has really been driving a lot of disruption across sectors, not just in the technology or communications space. And so, yeah, we think that these business models are going to continue to gain competitive advantage as AI permeates more of the economy and more of their business models. Right now, we're sort of in the early innings where a lot of the capital spending around AI is really going toward chips, as we know, right, with Nvidia and others. That's really the training phase where these companies are taking, in most cases, their first party customer data and training large language models using these chips. The next phase, which really we're not at yet, would be the inference phase. And that's taking all the data that these large language models build and using it to drive your business, drive deeper connections with your customers, find new areas of growth and business opportunities. And admittedly, that's a little bit opaque. We can't see the future. We don't know quite what those business models are going to look like. But we have a lot of faith that AI is going to be really transformative over the long term. The analog I might give you, again, dating myself, is going back to the internet boom of the late 90s and 2000s. Then we were sort of laying the plumbing for the global internet. And the names of the day then, the popular names, whether it's Cisco, Intel, JDS Uniphase, these types of companies, what ended up happening is the popular companies of the day weren't necessarily the companies that benefited long term. Okay, so it's very hard for investors to identify winners right away in this process, right? But the internet itself ended up being magnitudes larger and more important than anyone could have recognized in 1999. I think the framework is applicable to AI, where yeah, everybody's heard of Nvidia. Everybody understands the stocks that have been benefiting from this early theme. Um, I don't know that I'd bet that I think the list will change over time, right? But I think just like the internet, AI will prove to be even larger, more pervasive, more impactful in our lives than we can even conceive of today.
You said before you have faith in the AI theme. I feel like there's a lot of hope in artificial intelligence and
Yeah.
how it will change our lives. Is there anything that you're worried about? Perhaps that we're spending too much money on GPUs for applications that may not even exist?
Yeah. Very fair question. I understand where that comes from, and I would share some of that, skepticism, if you will, or concern. At this point, it's not entirely clear what new revenue models are going to be built on the back of this new technology. I think, knowing a lot of these companies and these management teams for, in some cases, decades, we do have to have some faith, right? Our clients allocate capital to us and say, "Hey, we don't know what to do with this. You tell us how to, where to go and allocate capital." And then we turn around to the companies we invest in and essentially ask them the same thing, right? Here's our client's capital. You allocate it how you see best. You've been successful over the years at creating and sustaining business models. So there is a little bit of an element of trust there, for sure. And I think if there's something that concerns us, let's say over the next 2 or 3 years, it would be that handoff, right? From the building up of the infrastructure to support AI, where we are now. That's easy. That's pick and shovel providers. That's just buying more chips, larger clusters within data centers, faster chips, what have you. The second phase is going to be, well, what do we do with it? How do we monetize that? Um, I can't see the future necessarily, but we can recognize patterns and we can learn from history. And I think, again, history would suggest that these companies have been hugely innovative over the years. I think they're likely to continue to be innovative and to find ways to use AI, not just to help their business and create new businesses, but this is a broader conversation. This goes well beyond Google and Meta and Netflix and the like. We've been talking this week a lot with our clients about non-tech companies that we think are going to be beneficiaries of AI. Everything from a fast food restaurant, right, to Deere, which makes tractors, right? So the conversations that we have internally at Janus Henderson are broader than just this specific question that you asked, although it's a very good one. We're trying to think long term, who's going to win and who's going to be disrupted by AI.
As I mentioned in the first question you guys have done exceptionally well over the last 5 to 10 years when we've really seen growth outperform. Over the much longer term, though, value has historically outperformed growth.
Mhm.
With all the innovation that we're seeing today in the market, is this the death of value investing? Is it growth from here on in?
It's a very dangerous question to ask an investor. I would never say it's the death of this or that. I think, we tend to not necessarily think along the lines of value versus growth. I think as global interest rates hopefully begin to come down, logic would suggest that that's going to lead to a broadening in economic growth. And companies that require the capital markets, require the economy to do well, will benefit at the margin from lower cost of capital. So I think it's logical to expect, hopefully, I think, a broadening of the market. It has been a very growth driven market. We appreciate that. But when we think about growth investing, it's really, if you think about the world, particularly the developed world, demographics of this world are not particularly supportive. China has very difficult demographics, Europe as well. And so what that means to us is organic growth is scarce and likely to get scarcer over time. And so we think scarcity gets priced and rewarded in the market. And so rather than think about growth versus value, we really like to describe ourselves as business model investors. We're trying to find businesses that can efficiently convert capital into after-tax free cash flow, right? Think of it like an engine almost. And if we can find and own efficient engines on behalf of our clients with companies with strong corporate governance over time, I think we're going to be in really good stead long term, whether it's a growth cycle or a value cycle. Although I do appreciate your question, I do think it's likely that if global interest rates do come down, we should expect a broadening out of both the economy and the financial markets.
We'll get into your investment process a little bit later on, but first I want to step a little bit back and talk about the big picture. We're definitely feeling some pain from interest rate hikes here in Australia, at least I am. Are you seeing the same thing in the US? What are you seeing in the data? And what conclusions would you draw from these when it comes to the Fed?
So I'll take you back to March of 2022. And I remember where I was when I realized that the world was changing. When Jerome Powell and the Fed signaled that it was serious, right, about getting off of zero interest rates and creating a real cost of capital. Since then, we've had about a 500 basis point hiking cycle over 2+ years. That's pretty historically huge. And so, what has that meant for our businesses? Well, in the United States, I think Australia is likely not much different. In the United States, big ticket durables like homes, cars, home appliances, things like that are invariably financed. And so the cost of money, in a very real sense, is the price of the good. Um, and so when interest rates started to rise, what we started to see was essentially a unit recession in big ticket durables, things like cars, things like furniture, things like anything that the typical consumer would have to use credit for. Um, I think we went into that cycle a little bit earlier than Australia did, right?
Mm.
So there's this FIFO principle, first in, first out. I think that's playing out to some degree. Inflation in the United States, as measured by CPI, is now within the Fed's target, right? So we've never been in the structural camp around inflation. We've always felt it was transitory and largely supply driven around the pandemic. But it's taken a lot of time, right, to work through the system. The impact of cumulative inflation, which I think is the right way to think about it, is still quite significant and putting a lot of pressure, particularly on lower income households in the United States. If you think about it this way, typical household necessities, whether it's eggs or milk or insurance, things that you have to pay for just to live, those are up somewhere 30 to 40% over the last 2.5 years.
Mm.
And what that's meant for consumer spending in our country is that there's been a crowding out effect of discretionary goods, right? There just isn't enough money left over at the end of a month for many households to splurge on something that, on the wants as opposed to the needs. Um, how does that rectify itself? Well, part of it's lower interest rates, right? That helps going forward. It makes things cheaper to finance. But I think behind all of that, what's going to get us out of this situation is steady nominal income growth. right? And falling inflation. So real wage growth, as we measure it in the United States, has been positive for several quarters now. And that's slowly helping the average household dig out from the effects of cumulative inflation. And from what I've been able to gather so far this week in Australia, it seems like your country's generally on a similar path, probably just a little bit later than ours.
How is that impacting corporates? I imagine a lot of consumers in the US have been trading down. What companies are benefiting from that and what are really suffering?
Yeah, great question. So, stepping back a little bit, I'll try to address your question with sort of a longer term framework. Um, Traditional consumer companies, if you think brick and mortar retailers like department stores and so forth, those business models were intentionally built to have to support a high fixed cost structure. Escalators and brass and marble are expensive, right? And store employees are expensive. The winning business models, as we see it over time, have been businesses built on speed, throughput, and velocity as opposed to a margin rate, right? And so instead of thinking about making something off of your customers, right? Um, the businesses that are winning are actually delivering value to their customers day after day after day. It doesn't necessarily mean it's a high margin business, but they can be huge businesses. Costco is a great example of this, right? If you want to understand Amazon.com, for example, first study Costco. That was the Amazon of the day before Amazon. And so, what does that model look like? It's a membership model. You pay January 1st, you pay your fee. The prices are incredibly compelling, right? Value doesn't have to mean cheap, by the way, right? A lot of the items that are sold in a Costco would be considered almost luxury goods, but they're sold at such compelling prices, right? That people just are clearly finding the value there. And on the back of that, Costco's built an enormous business, right? Costco is still a very low margin rate business, but because it turns its inventory so quickly, it can earn really attractive returns on capital and returns on equity. So we look at businesses like that as kind of the future because they're on the side of the consumer. Right? They're not trying to earn something off the back of their own customers. They're trying to deliver value in a repeatable way. And every year, Costco or Amazon Prime adds more benefits, more services, more value to that membership. We do a lot of work around that, trying to understand what that means. So, for example, a standard Costco membership in the United States is about $65 per year. When you add up all the benefits that you get, from preferential insurance pricing to tire rotation to travel services
Wow.
to optical care, the value to an average Costco member is multiples of that. We think those are winning business models over time because they're aligned with consumers. They're not in opposition to them.
Okay, we're going to take a quick break to hear a message from our partners, and then we'll be right back with Josh Cummings from Janus Henderson. And we're back with Josh from Janus Henderson. Josh, I want to talk about regulation now. Nvidia has been slapped with antitrust charges. What does that mean? And as an Nvidia shareholder, does that make you feel worried?
Boy, there's a lot in that question, Ali. Here's what I would say. It's understandable to us that the regulatory authorities in the US, predominantly the Department of Justice, would have concerns about the sheer strength and scale of some of these business models. Unlike a traditional analog business model, if it were, let's just take a retailer, you have to, by definition, scale linearly. You have to plant the flag, you have to open stores, you have to build physically into the market. That's not necessarily how digital business models work, right? They can scale non-linearly, which has been fabulous for us as investors, obviously, and for our clients. But it does open new questions around, are we defining market power the same way as we used to in a prior generation? Is that even appropriate anymore? Is there a different framework we need to use to analyze these companies? I'm not an attorney. I'm not a regulator. I won't necessarily dive deeply into that. Nobody should listen to my opinion there. But back to NVIDIA, no, I would say overall, we're not overly concerned there. We don't see an issue here with abuse of market power or anything like that. Nvidia right now is enjoying something akin to monopoly status, right? But they've gotten there through innovation. They've gotten there through taking massive risk, right? And investing hundreds of millions of dollars in these capabilities. And so, yes, they're being rewarded at the moment with near monopoly power and incredible pricing power. But we don't expect that to last forever. There's going to be competition. There's plenty of other semiconductor companies that will eventually catch up. It should be a competitive world. That's okay to us. And a lot of times, what we see from the regulators is sort of coming in after the horses left the barn, to use a phrase popular in the U.S. So while we understand the I guess the nature or the 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 intent behind increased regulation, oftentimes we feel it's like it comes too late, and they're often kind of fighting the last war, if you will. So I'm not going to make any predictions here, but no, it isn't something that would structurally concern us about NVIDIA's business model.
Let's get into the weeds now. Obviously, the fund performed exceptionally well, beat the benchmark over the last 5 and 10 years consistently. How do you identify winning growth stocks repeatedly? What are some of the factors that you believe have proven to be consistent indicators of success?
Yeah. I'll start by saying we are business model investors. I can't say that enough. What does that really mean? If you think about a business like an engine, we want efficient engines, right? That may mean a capital light model, or it may mean a capital heavy model, but that can also generate a ton of free cash flow from that capex, right? From that capital spending. So we're looking for efficient economic engines that we think have sustainable competitive advantages, sustainable moats to their businesses, and importantly, rather than harvesting free cash flow, I mean, everybody loves share buybacks. That's a shareholder friendly thing to do. But for most of our companies, we're actually more in the other camp. We're advising them to invest, continue to invest. Why do you do that? Well, competitive moats don't last forever, and it's very important that these companies continue to innovate and invest. And so we're really happy with what we're seeing. We want our winning businesses to continue to invest. That's how moats get wider. And frankly, that's what defends what might seem like high earnings multiples, let's say, right? All a PE ratio is the stock market's interpretation of your life expectancy in a way, right? How long can you grow? And so, what we look for over time are, like I said, good business models, responsible corporate governance, very, very important. And then we generally try to leave them alone, right? A lot of investors, people love straight lines. That's easy math. People don't like curved lines. That's hard math. But that's what compound interest is. And so at Janus Henderson, there's many examples of companies that we've owned for 20 plus years, right? So when you find a good economic engine run by responsible executives with good corporate governance, leave it alone. Let them do what they do. Let that compounding work for your clients. Go try to find the next one.
You said responsible executives just then. I feel like there's so many
Is that an
celebrity,
oxymoron?
I don't know, there's so many celebrity CEOs in the US, like Elon Musk,
Yes.
for example. Is that a red flag for you when there are those CEOs who are always in the media or over promotional, that kind of thing?
Yeah, I'm gonna speak a little bit more personally. I don't know if I want to speak for all of Janus Henderson, but I would generally agree with that statement. There was a company way back when that we were invested in called Ross Stores, and they're a lot like TJ Maxx here in Australia. They're an off-price retailer, and I remember having a conversation with the CEO at the time, and this person never did conferences, right? Wall Street Bank conferences, things like that. Barely spoke on conference calls, wouldn't really meet with investors. And when I sat him down and asked him why, he said, "Well, don't you want me running the business? Right? Isn't that my highest and best use, running the company? Why do you want me up at a lectern, with a slide deck, right? That we have investor relations for that." And so generally, I would agree with you. You know, uh, you mentioned Elon Musk, so it's worth maybe a second on that. I'm no expert on Tesla, but that is a company where we do have corporate governance concerns, frankly. And so, we don't happen to own Tesla internally at Janus Henderson at the moment. Most of that is a business model decision. The business of manufacturing automobiles is not a particularly high return business. And when we do the analysis and we value Tesla's automaking business at what we think is a fair multiple, what we find is there's sort of an unexplained several $100 billion hole there, right, of market cap where we can't necessarily figure out why are investors assigning all this value to all these other things, whether it's SpaceX, or low Earth orbit satellites or full self driving, things like that, right? So we haven't been able to get super comfortable with the business model. And I would also say corporate governance, absolutely a concern, right? And the fact that Elon Musk now controls, a fairly large social media platform as
Mm.
well, it's a little bit troubling to me personally.
What happens when a growth stock gets too hot? We've seen a lot of companies run incredibly hard. How do you know when to sell? Or should you hold on for dear life?
Yeah. Um, Now you're getting to the art versus the science. And investing is a trade. It's not a white collar job, in my view. It's a blue collar job. It's a trade. They don't teach it to you in school. They don't even teach it to you in business school, quite frankly. And I went. You learn by doing, you learn by making mistakes. And so, to answer your question more thoughtfully, I suppose, we absolutely are aware of sentiment and momentum. And when stocks, let's say, go parabolic upward, as responsible capital allocators, we are likely to probably try to move the other way, lean the other way. However, it's very rare that we would just simply exit a business model that we loved, even if the stock got overheated. What we're trying to do, again, is find great business models which over time should beat the market. And then if we can thoughtfully trim or add around the edges when sentiment is in our favor, right? When people are scared, we want to step in. When people feel like there's no risk in the world and it's easy money, that's usually a signal to pull back a little bit, right? So if we can own those winning business models over time, and then hopefully through thoughtful trimming and adding, if we can bat a little bit over 500 in that, we're never going to be perfect. We don't get all of those right, but we think we can get more right than wrong. Will outperform those stocks over time, right? So that's how we think about it.
I want to go back to AI. The portfolio holds stocks like Nvidia, ASML, and Taiwan Semiconductor, as well as the cloud providers slash hyperscalers like Microsoft, Google, and Amazon. You're also invested in some smaller, lesser known AI beneficiaries that are disrupting their respective industries. Before you talked about Deere.
Mhm.
Can you take us through a few examples?
Yeah, absolutely. Maybe we'll start with Deere. Is that okay?
Okay, sure.
It's such a fascinating company to me. I often use Apple as an analog to Deere, and that usually perks people's eyebrows up. They're like, "What? What's he talking about?" Well, Deere is a hardware manufacturer, right? They sell tractors and combines and things, hardware to help run farms. They have an initiative that is now, several years old. We think AI is only going to kickstart this, called precision agriculture. Well, what does that mean? If I'm a commercial farmer and I sign up for this precision agriculture program, essentially what I get is a portal, a home page, a portal with all kinds of analytics that essentially help run my farm better. This is software that learns over time about planting seasons, different sorts of fertilizer, pesticides, what works, what hasn't worked for you over time, ultimately helping me, the commercial farmer, with my yield, which is really what it's all about. And so that's maybe one example where software is already driving that business, and we think AI only jumpstarts that going forward. Maybe one other example I'll provide that Aussies may or may not be all that familiar with. It's a restaurant called Chipotle. Chipotle is a very simple business. They sell beans, rice, and cheese, essentially, and vegetables. Um, what's interesting is this is also an incredibly innovative company. So several years ago, they set up a venture fund to essentially seed companies to develop new technology solutions that may help Chipotle's business long term. Think about something as simple as coring an avocado. Okay. Doing that by hand with a paring knife is dangerous for employees, right? And it's time consuming, it's repetitive, physically demanding. They now have a solution that's currently being tested that can process 50 pounds of avocado cored and peeled in a matter of seconds.
Wow.
Really incredible, right? Now, that's not really AI, but it is a good example of how technology can not only help a business model, it can make life for manual labor a little bit easier. A big theme in retailing across the world right now is the automation of distribution centers and supply chains. If you think about a human having to make up a pallet, right, to go on a truck or a ship, you're bending over, you're lifting really heavy boxes. That adds up to healthcare costs, legal costs for these employers, right? Um, why would we have a human do what a machine or a robot can do easier and safer, right? So when we think about AI and its ability to, I guess, replace jobs, it can sound very scary, right? But to me, it's actually a very positive story. In many cases, these are jobs that are hard to fill. They're jobs that turn over a lot. They're dangerous. They're just not really good jobs, right? And so it's just the natural development of a developed economy is to continually sort of automate those labor-intensive, difficult, dangerous jobs, which will in turn free up our labor force for more interesting, more intellectually satisfying, more safer, knowledge-driven jobs. And that's how economies evolve over time. So we're quite positive about the long-term impacts of AI. And we don't see it as a situation where, we'll no longer need attorneys or things like that, right? But what we might be able to do is free up attorneys to spend more time with their clients and less time wading through stacks and stacks of paperwork that an algorithm can do a lot better, a lot faster, and more accurately.
Your team met with Sam Altman, the CEO of OpenAI, a few years ago. I'd really love to know. I wish I was a fly on the wall for that meeting. What did he say that convinced the team on AI?
Well, to be clear, I was not present in that meeting. That was the head of our technology team, Denny Fish. Denny, like me, has been doing this a very long time, some going on 30 years or so. He has gray hair, just like me. And I think, again, when you have these long-term relationships in the industry that you're responsible for, you get to have these kinds of conversations, right? And I think, if I can paraphrase some of what Denny said, coming back from that trip, um, it really just convinced him that this was real. This wasn't a science project. The technology was real and it really does work. And it really got him excited and us excited about digging for opportunities in that world. And, that was at a time when AI was known, it was a buzzword, but it wasn't really commercialized in any way. It was still sort of a dream for people. And if that conversation, if that meeting did anything for us at Janus Henderson, it was to, I guess, awaken us and alert us to the potential here and how important and pervasive it could be in the economy. And what happened as a result is our analyst teams went off and started really thinking about this, asking our companies about it. I cover a lot of what you would, I guess, deem to be mature slash boring businesses, right? Big retailers and restaurants and so forth. Increasingly, when I'm having conversations with the executive teams of these companies, I'm straight up asking them, what is AI going to mean for your company? How are you going to use this to your advantage and avoid being disrupted by it? And, had I asked that question 12 or 18 months ago, I might have gotten a lot of blank stares from executives. Not so today, right? So it's as it becomes more pervasive, as people learn more about it and about its potential, the most responsible companies that we invest in are ahead of the curve. They're trying to think 5 years ahead, right? And again, 5 years from now, that's opaque. Nobody can divine the future with perfect accuracy. But what we should expect of our companies that we invest in is that they are doing their best to look further out and think about how they continue to build competitive advantage, again, to extend the duration and the life cycle of their business models.
Are there any companies that you think are going to be disrupted?
Yeah, this is not a terribly satisfying answer, even for investors like me. We do think it is a world where the big, unfortunately, continue to get bigger, which may lead back to the regulation question a little bit, right? But if you think about something like technology, let's say you're a retailer. Let's say you sell clothing, and you have two or three stores, and you want to hire a software engineer to build the greatest app, in the industry. Well, that software engineer is going to cost what she costs, right? She's not going to be willing to work for a percent of your revenue, right? And so, unfortunately or fortunately, this gives big companies a huge advantage. We've been seeing this and observing this in our portfolios for years. the benefits of technology are increasingly accruing to scale.
Interesting. I've definitely heard the bull thesis on AI a lot of times, probably a million times. I feel like I'm the only skeptic, even though I do own Nvidia in my portfolio. I have to admit that.
Okay.
What do you think could go wrong? I feel like I've seen enough Hollywood movies
Mhm.
to know that, I don't know, robots could take over the world one day. iRobot, Will Smith. Is there anything that you think investors should be worried about or scared about? Should there be a kill switch for AI? I guess I'm saying.
Yeah. Well, I'm not a technologist, but I completely appreciate the point you're making. It gets a little dystopian at a
Yeah.
certain point, right? What's real? What's fake? Can we completely replicate the human brain? I don't happen to think we can. I think there's always going to be room for human judgment. I think that's very important. I don't think you can outsource something like investment management to a machine necessarily. Sure, there's a place for that, and there are firms that do that and do that quite well. But we believe in the power of judgment and working together as a team to come to the best possible answers we can. Um, I think more near term, something that concerns me, and I think we touched on this earlier in the podcast, is just the handoff from the build out to the actual monetization phase of AI. I'm a betting man, I guess, by nature, by my career. I doubt that's going to go perfectly smoothly. I don't think it will always be graceful. So we are prepared for that. I think there's going to come a time when the money's been spent, right? And the shareholders of these companies are going to expect business models to be built on the back of this. Again, we're confident in that long term, but it wouldn't surprise me if there's a period of time within the next 2 or 3 years where the market really does doubt whether there's a there, so to speak, right? Is there something at the end of this rainbow?
Mm.
Again, I have faith that there will be. I have faith in the companies we're invested in terms of creating new solutions for companies that we can't think of today, right? Imagine going back 15 years and you're standing in the middle of Manhattan, not knowing there was going to be an Uber, right? Who knew that yellow cabs were essentially going to become defunct and worthless, right? Um, so that's just a proof point there that you never really know what's going to happen. There is an element of faith here, but if there's something that would concern me, at least within our investment horizon, it would be that. It would be, do we have a clumsy handoff here? Does the market start to come to a conclusion that all of this spending on high performance GPUs and high bandwidth memory, is the market going to get to a point where it really doubts the ROI of all of that spending? It's certainly within the realm of possibility. So I would say that's a concern of ours.
But no iRobot scenario anytime soon.
I do think we're somewhat a ways away from that. Maybe let's use self-driving, right? Autonomous vehicles as an example. You could have gone back 10 years ago, even longer, and that was a dream of investors, right? We're not there yet,
Yeah.
are we? Right? The uptake for Tesla's full self-driving software is still in the single digits in terms of Tesla owners who have committed to this and want to pay for this, right? So, as a long-term investor, 5 or 10 years is a snap of a finger. But to a lot of people, that's 5 or 10 years. That's a long time, right? So, yeah, I think that's how I'd answer it.
No, like look
Depends
at
on your
Back to the
time
Future.
horizon.
We still don't have floating
Exactly.
skateboards, so many flying cars.
That's exactly
There were
right.
so many promises made in that movie that we should have seen a few decades
Yeah.
ago now.
But there's examples on the other side, right? Unfortunately, I'm old enough. The first cell phone I bought was in 1999, and I was 29 years old. Right? Imagine that, right? I have a 14-year-old daughter. Um, she's completely fluent in mobile devices, right? It's never been a consideration of hers, right? So, um, again, stepping back, if you think long term, it's really remarkable. Some of the innovation that we've had and have at our disposal now, and think of how much easier it's made our lives, right? From booking a ride to the airport, as I'll have to do soon today, to buying things online,
Mm.
right? Way back when, I remember, I've had sort of a front row seat to observe Amazon's growth. I'm old enough to have been present at the IPO roadshow of Amazon in 1997, I think it was. And I remember at the time, everybody accepted, okay, you can do this in books, but you're never going to do it in clothing. How could you? You have to try things on. Oh, well, free returns? Problem solved, right? Now Amazon is by a wide margin the largest seller of apparel and footwear in North America. It's not even close, right? And who would have thunk that 20 years ago, right? So, again, over a shorter period of time, it might seem like things are progressing slowly, but if you really step back, it's been remarkable, the innovation in our economy over the last 20 or 30 years.
Okay, Josh, we've come to the last three questions of the podcast. They're meant to be fun, they're meant to be a thought experiment.
Okay.
First question: what is one thing investors are getting wrong about markets today?
Wow, that's a tough question. Excellent question. I think the market is still struggling to understand scarcity. Let me give you an example. A lot of what we do is in the media space with content and so forth. Live content is incredibly scarce, right? Think about scripted content, whether it's a TV show that you like, a quiz show, whatever it might be. That can be time shifted. You don't have to consume that in the moment, but an AFL game or a Formula One race, it's happening now. You need to consume it live. So we're trying to focus on areas that we think are going to become increasingly scarce over time because we think scarcity gets priced. And so I would still submit that most investors in the market don't necessarily appreciate that dynamic enough. And we talk about, sports team values rising inexorably, and gosh, that feels like a bubble. Well, I mean, how many new sports teams have been created in the last handful of years, right? How many Formula Ones are there? There's one. It's been around for 75 years. It's a global sport, right? So we try to focus on scarcity. And I think oftentimes investors don't fully appreciate that in the moment. So that's one answer, I think. The second thing I would say, and this gets back to sort of human nature a little bit, and humans not doing a great job with curved lines. Um, we're continually, I guess, surprised by the power of compounding and how many investors don't necessarily appreciate this, right? So it's very easy to say, I want to invest in a high ROI business model. What's controversial about that? Um, but if you turn your portfolio over 80, 90, 100% a year, what's the point? You're not benefiting from the power of compounding. And so, as simple as it sounds, I would still submit to you that the market doesn't always price that appropriately.
Okay, next question. You've worked in markets for 28 years. What is a story of a big loss or a big win from your career? And what did you learn from that?
Ooh. Well, I won't say an absolute loss. I would say a missed opportunity. You know, I've been doing this long enough to understand, hopefully, and be able to identify winning business models. And I kick myself sometimes for not simply just investing in some of these winners early on and just leaving them
So
alone,
do I.
right?
So do I. I have so many stocks that I'm like, why did I not invest in that years
Exactly.
ago?
Right. And that's where you see the power of compounding, right? You say, how can the share price be here?
Mm.
Well, 8% times 8% times 8% times 8%, that adds up pretty quickly, right? Let me give you a visceral example. In full disclosure, I am currently a shareholder of Amazon in my personal account. Um, you could have waited a decade after Amazon's IPO in 1997, okay, which would have put us at 2007, right? Which for you history buffs was right before the biggest economic calamity the free world has really ever seen. You could have waited a decade, purchased Amazon in 2007, you'd be up something like 30,000% today, right? If that's not an indication of the power of long-term investing, I don't know what is.
Mm. Yeah, mine was Apple. I remember it became a $1 trillion company, and I thought, oh God, should have invested in
Can
that
I share
years
something with
ago.
you related to Apple?
Yeah,
Because
go.
I too have an Apple related story. So at the time, we're going back to, let's say, I don't know, 2003, 2004. I remember when the iPod first came out, right? Your music library in your pocket, right? And it was just a thing. It was leading edge. Some people were getting it. It was just the real techies of in our country were sort of gravitating toward this. And I covered retailers as well. And I remember walking into a Target store, just a normal store check. This is what I do. I'm in stores all the time. And I remember seeing an end cap, a little display with an Apple iPod on it, right? I don't know why the light bulb did not go off for me in that moment. And if you go back to that time period, 2003, 2004, and I'm going to get this wrong, I'm approximating, but most of Apple's market value at the time, was actually represented by the net cash on the balance sheet. They had something like, call it $10 or $12 a share of net cash on the balance sheet, and the stock was trading for something like 15 or 20. Wow, right? What a miss.
Regrets.
What a miss. You're right. And I go back to, there's a famous investor in the United States called Peter Lynch. He's long out of the business, but really one of the foundational investors in my opinion, really built Fidelity in many ways. And he has this sort of mentality or framework, buy what you know. Right? As a consumer, if you see something, if you have a great experience with a product or a service or any kind of consumer service, well, that's invariably a pretty good idea for an investment long term. And I should have listened with Apple, right? I had an iPod. I loved it. I saw it, mushrooming everywhere into more and more retailers. I don't know why I didn't listen to myself, right? And buy the stock right then and there.
That's a really great lesson.
Lots of regrets.
Oh, yeah, but I love it. It's really relatable. Buy what you know. Don't ignore that little feeling inside that's like, oh my God, this is awesome.
Look, if you think a good or a service is really cool and really, valuable to you, chances are other human beings are going to think the same way, right? There's many more similarities between us really across the globe than differences.
Okay, last question for today. And it's my favorite as well. It's a little bit of a challenge. If the market was to close for the next 5 years and you could only back one stock, which I know is incredibly painful for fund managers to try and answer this question, what would that stock be and why?
I'm actually really glad you asked me this question, Ali, because we think a similar way on our team. And I'm speaking of my consumer team here. We like to ask the question, if there were no stock market and you were offered 100% of this company, sole ownership, would you own it or not? Right? And that should actually be the litmus test to would you buy it in the public market as a stock, right? So it's an excellent question. I think that the one company that comes to mind for me would be Formula One, Liberty Formula One. Again, this is the premier open wheel racing series in the world. That's been the case since 1950. They race in 20 countries throughout the world, 24 races right now in the season. Each one of those races attracts somewhere in the order of 300 to 400,000 fans, live attendance, right? So that's, call it 3 times the size of our US Super Bowl.
Wow.
So think about an asset that you can own. You own the global rights to the sport, including the digital rights. Okay. You own that globally. And your offering is, 24 live events that each larger than the Super Bowl. That's pretty special. Right. And so we never want to say a business model is forever, but to me, Formula One is about as close to a forever business as we're able to find in the public market. And again, scarcity gets priced, and we like owning scarce assets.
Well, thank you so much for your time today, Josh. I absolutely loved talking with you. It was so much fun. Thank you again for your time and safe flight back to the US.
Thank you so much, Ali. It was a pleasure speaking with you. I really enjoyed it.